I am here with a little bit of an urgent warning to all of my viewers out there who are investors in Uber stock or who might be considering investing in Uber stock. Don't believe the hype. The stock's most likely going nowhere. Hey everyone, this is Kevin the Apptrepreneur. Welcome to my channel. If this is your first time here and happen to like these videos, please do me a favor. Hit that subscribe button and ring that bell notification. We upload on a near daily basis and you will want to be notified of when those videos in fact do go up. So anyway, I haven't talked about the stock in a little while, and I kind of said that I wasn't planning to for a while unless like something drastic happened, but I think I kind of need to discuss a little bit because you know what? People keep commenting in my videos, well, should I buy Uber stock? I mean, analysts are telling me I should buy Uber stock. Like, it looks like it's going up. What do you say? Why do you think it's not going to be around in a couple of years? I mean, guys, first of all, full disclosure, I am extremely biased. I'm not even pretending anymore. I stopped pretending a long time ago. I'm extremely biased. I would be perfectly fine with this company going away. I really would. I mean, I would like to see them improve and get better, but after almost 4 years, really 4 years, because I was like driving for Uber for months before I started making videos, I'm kind of over it. They're not going to improve. The only time they improve is when they are legally supposed to improve, and they are doing everything they can to fight every legal thing that makes them a better company for the drivers. But that said, I do have a share of Uber stock, one Uber stock, because it's a vanity stock. And what a vanity stock is, for those of you who are not aware, it's a stock where it's like you want to say, I own a piece of the company. You don't buy it because you think it's going to actually go somewhere. You just want to own a piece of the company. Other vanity stocks that I have owned were Barnes & Noble before they went private, and I sold the stocks and actually made a little bit of money off those, and IMAX, which, God bless them. I love the IMAX company. I love the format, but man, they have made some pretty boneheaded moves, and I don't see them growing anytime soon. But I have one stock because I like the company. So let's look at the stock, Uber stock right now. It closed at $34.68 today. After hours, it's up at $34.72. Now, when you see this is not a stable stock. It kind of looks like it's edging up, but you're not really sure. Well, if you look at the month, it does look like it's creeping up. It does look like it's actually creeping up. However, when you go to the max, you can see it's still way down from what it was. But when you see this, it brings credibility to articles like this. The Uber stock rally is real, at least according to one analyst. The rebound in Uber shares this month is the real deal, according to Guggenheim Securities. Uber technology stock fell more than 30% in 2019 from its $45 IPO price as investors grew impatient over the company's biggest loss. However, the stock has risen about 17% this year. Uber is slated to report its fourth quarter earning results of February 6th, according to the company's website. They will be losses. I don't know if it's going to be $1 billion, but it'll be pretty close to $1 billion. Now, we have to subscribe to read the whole article, but I'm not going to do that. And in fact, really, the article isn't even that important. But here's the headline. The Uber stock rally is real. That translation, you need to buy this before it goes up. You just need to buy this. And by the way, I have read another analyst say that they anticipate the stock hitting $40 per share this year. Which, hey, if any of you bought the shares at the IPO price, I guess you're not losing quite as much as you originally thought you would, unless you already sold the stock. But here's the thing. You have to be cautious about these articles. You have to be cautious. And I'm going to tell you why. Because on one hand, you have an article like this, but then you have articles like this. This one I didn't comment on because this was an editorial, and we're kind of moving away from editorial stuff. But Uber CEO made a huge mistake, and it may just signal the end of Uber. This is from Incorporated.com. This is a very respected website / magazine, or really it's a digital magazine. And in this article, I'll kind of sum it up. Basically, they go over how Dara Khosrowshahi's biggest mistake is that while Travis Kalanick maybe not have been a good CEO, he was at least an innovator, and he should have been kept on in a consulting role, kind of like Steve Jobs. I don't know if Travis would have agreed to that, but he writes this long article on why letting Travis walk basically is bad for the company. I think there's a compelling argument to be made there, but I think he needed to go. But it's not just this article. Uber has real things they have to face. For example, they have to... no, I don't care about the cookies. They have to fight AB5. And AB5 makes their path to profitability a lot more complicated. For that matter, let's go over here. You have the Motley Fool writing right here. Uber, one step from greatness. So all these sites, they want you to subscribe to something. And yeah, that's a pretty bad graph. So what is going on? Why is it so many of these sites are writing bad articles, but this one is writing a positive? Here's what you guys need to keep in mind. While for journalistic integrity, the authors should disclose whether they have a personal stake in the company succeeding or failing, they don't legally have to do that. They don't. And another thing is, when you are writing about the stock market, I know this because I know people who write for some of these stock analysts. They personally do not buy stock of the companies they're writing about. However, they have LLCs, family members who manage trust funds. They have third parties who buy and sell stocks for them. And it's officially the company's money, but underneath, it's the person who's writing the article's money. You don't know exactly what the writer has in stock, forgive the pun, for the company. You also don't know what they're going to short. Like, for example, it came to light that a lot of the positive MoviePass stock is a great investment articles. A lot of people writing these articles were caught to have been short sellers. That means they were betting on the stock to fail. So they would write these articles, make it look like everything's hunky-dory, get people invested, and then they would short the stock. It's kind of a real-life thing of what the producers did. It's kind of amazing that it's legal sometimes, but there you have it. And so when you read articles like these, you have to be careful. Some people might be trying to short the stock. Some people might personally have something to gain from the stock. And sometimes you don't even know who's sponsoring the article. I mean, in some cases, the articles are paid for by the companies. And they don't always need to disclose that they're paid for the companies. I mean, they can, but they don't have to. And it kind of depends on the site's credibility. And when I tell people to be careful about buying the stock or any stock, and again, this is not financial advice. You do your own thing. If you have a broker or a lawyer, talk to them before listening to me. I'm just a jackass in a beanie making YouTube videos. But you do want to pay attention to what's going on with the company. And I mean, you want to really pay attention. Because here's the thing. This analyst, Tai Kim, I think that's how you pronounce it, Tai Kim, says, hey, the stock rally is real. Or whoever was at Guggenheim Securities. It's real. Get on board. The train is moving up. And yet, you have the co-founder of Uber, Travis Kalanick, selling all of his stock and severing his ties with the company. Now, in itself, that is not a big deal. I mean, Kalanick could have sold for whatever reason. Hey, he's still bitter at the company for ousting him. He realized he was never getting control of the company again. They didn't let him ring the bell at the IPO. He has this new company he wants to invest in, and he needs some seed money. There's a lot of reasons why he could have just completely severed ties with the company. However, then you have another employee, a longtime employee, a VP, getting out of this company, Rachel Holt. She's no longer with the company. We just talked about this. And we also just talked about this. Goldman Sachs dumped their entire stake in Uber. They dumped their entire stake in Uber. Didn't even tell anyone. There's rumblings that SoftBank might even be selling some of their stock too. You kind of look at these things and it's like, that does not suggest this is a healthy company. In fact, if anything, this suggests that the company is in dire straits. I mean, when you see, I don't know how many people have ever been on like a sinking ship or something. I mean, I thank God haven't. But whenever you see like a bunch of rats running away in unison, that's usually a sign that the boat's sinking. The rats are trying to get away from the water. So follow the rats. Get off the ship. And here's the thing. You can tell that this is all personal opinion. You can all tell that it depends on who has a stake in what, because you have articles like this. Uber looks better than Lyft stock, and here's why. Over here, 3 reasons Lyft is a better buy than Uber. They can't both be right. They can't both be right. The only way they can both be right in this crazy scenario is if both the stocks were healthy. They're not. In fact, the Lyft stock isn't doing a whole lot better. It's not doing as bad as Uber. It seems to have settled on between $45 and $40. Still almost half off what the stock started at. Like, neither of these companies are doing very, very good. And there's a lot of articles out there which we don't have time to share, but you can look them up yourself, and we might even talk about them a little bit, who knows, where people are really genuinely wondering, like, what's going on with these companies? Like, can they even survive this year? And look, I've been predicting it for a while. Again, I've called a lot of things with these companies. Not everything, and I'm not like a seeing guru, but I've got a pretty good finger on the pulse of this company, of this business, if you will. And it's not even just the investors. Look at how many Uber tubers have gotten out of this. They're like, hey, we're not talking about this topic anymore. Like, we want out. And they are having much success by getting out of this industry. They're all leaving. So here's the thing. I'm not going to tell you what to do with your stock now. I don't know how much you bought your stock for. I don't know what your plans are. One of the philosophies that I run with buying stock personally, I tend to have 3 rules. I only buy what I can afford to lose, which is 10% per paycheck, YouTube earnings, whatever. I try to focus on dividend-heavy stocks. I try not to let my portfolio, like, one company cannot have more than 5% of my portfolio, just in case one of the companies, goes under. And I'm going to try to move that to 2% at some point. And finally, I'm a long-term investor. I rarely do day trading. There are certain companies that, while they consistently go up, they tend to typically dip during earnings announcements. So for a couple companies, I won't say which ones because, again, this is not financial advice. I will sell all the stock an hour or so before the earnings call, see the stock drop, and then rebuy the stock at a cheaper price. That's dangerous, by the way, because sometimes if they have a good announcement, then stock could go up. But there's at least a couple companies that consistently disappoint in the earnings, but they ultimately creep back up. So those are my rules, and for those reasons, Lyft and Uber would never be something I seriously consider investing in. Yes, I do have stocks in both of them. It's a single stock in each company. And I have a single stock in Grubhub, too, for that matter. Because I talk about these companies and their success, I guess, kind of built my success, I kind of feel like, yeah, I should own a piece of that for vanity's sake, but they're going to zero. They're going to go to zero at some point, and it's going to be a loss. It's going to be a complete loss. So yeah, be wary of these articles. There are many of them. They say different things, and you just don't know what position they're coming from. Do they have something to gain from this company either succeeding or failing? Like, personally, I don't have much to gain if Uber succeeds or fails. If they fail, I get great articles. If they succeed, I get slightly less interesting articles, but, people will still watch the videos. So that's my personal opinion about all of this. Now then, what do all of you folks think? Do you agree? Do you disagree? Do you have stocks in any of these companies? And if so, why? And if you do you plan to sell them anytime soon? I would love to know what your opinion on all this stuff is. So, as always, comment below, like, favorite, share, subscribe, and as always, flame responsibly. Have a good one.